rupee opened the earlier week a tad weaker at 74.44, but the dollar's weakness against the major currencies and a significant rise in the global stock indices influenced the rupee to move gradually higher during the week. The high and low in the period being 74.09 and 74.63. We have observed that RBI is absorbing most of the dollar supplies from the market to boost their Forex reserves, leaving the dollar demand to be met by exporter selling at lower levels, which enable the rupee to maintain a stable range between 74.15 to 74.45. After exports registered a rise of 6% in September, the October exports declined by 5.12%. October imports also shrank by 11.53%, and the trade gap in October was USD 8.78 billion, narrower than USD 11.75 billion in October 2020. During April 2019 till October 2020, exports declined by 19.02%. The fall in exports flashed a signal to the monetary authorities the need to boost export growth in the coming months. The lower fall in non-oil and non-gold imports is an indicator of the strength of domestic demand. The country's Forex reserves touched a lifetime high of USD 572.77 billion in the week ended 13/11/2020, and the Forex reserves are sufficient to cover the imports for 14 months and provide more comfort to the central bank to intervene in the market on the sell side in the unlikely event of the rupee depreciating much above the 75.00 support level up to the end of December 2020. Due to accommodative policy stance being adopted by the developed economies in the globe, the pouring of capital inflows into the Asian emerging markets lifted its currencies higher and enabled significant gains in all the Asian stock indices. The local stock indices are expected to gain from the portfolio and other capital inflows into the market, but the gain in the domestic currency may be limited due to periodical strong intervention from RBI to curb the currency's rise beyond the 73.80 level. Though the domestic currency's rise may be limited, the local stock indices can be expected to rise in relation to the gains accumulated in the Asian stock indices. Indian assets offer the best return for overseas investors, and hence continuation of dollar investments and portfolio inflows can be seen over the medium term. We have observed that due to extension of trading hours by 90 minutes from 2 p.m. to 3:30 p.m. in the local Forex market, the volatility in the exchange rate as indicated by the high and low of the day has increased. From 9th November 2020 onwards till date, the high and low of the day showed a variation of more than 30 paisa per US dollar as compared with the tight trading ranges seen in the period prior to 9/11/2020. The central bank is making their best efforts to absorb the dollar supplies from the market as a result of its increasing Forex reserves. The average yield on the foreign currency assets of RBI is about 2.35%, mostly contributed by the revaluation gains in the gold reserves as the precious metal significantly rose in the last 6 months time frame. The current reserves of RBI at USD 572 billion covers around 14 months of imports. Any further sharp rise in the Forex reserves shall lead to the RBI thinking of various strategies to enhance the return on their foreign currency asset portfolio. RBI's abstention from the market, even for a short period, amidst the scenario of dollar inflows coming into the market, could fuel the rupee to break the 73.80 resistance and test the higher levels before the end of December 2020. The local retail inflation had risen to over 7% in September and October, and it seems quite possible that the retail inflation may not come below 6% in the January to March 2021 period, which raises the possibility of the central bank coming to an end of the easing cycle. As a result of a marginally higher short-term interest rates expected over the medium term, the forwards registered a 10 to 12 basis points rise across the maturities. The 3 months and 6 months forward dollar premium ended the week at 3.55% and 4.15% per annum respectively. The forward curve is looking flattish at the long end, with the forward market differential between the 6 month and 12-month maturity contracted to about 0.06% per annum.